Welcome, dear traders. Asian stocks have dropped sharply today following a collapse on Wall Street. All three benchmark indexes logged the biggest intraday decline since June 2020. The sell-off was triggered by higher-than-expected core inflation figures in the United States. Futures on API stock indexes stabilized early Wednesday. Yet, Asian stock markets are still recovering after the overnight plunge on Wall Street. The Core CPI Index, which the Fed takes into account when making key rate decisions, jumped to 6.3%. Such an unexpected uptick dispelled hope for a softer monetary policy. A hot inflation report spooked the remaining dovish policymakers. Moreover, there have already been rumors that next week the key rate may be hiked by 100 basis points. Traders felt bitter disappointment because prior to release of a core CPI data, optimism reigned on the stock markets. Besides flash estimates suggested a decrease in the core consumer price index, investors were pinning hopes for a slowdown in inflation, and this was the main driver for the further growth of stocks. And now there is none. Soaring inflation leads to high volatility in markets, increases the risk of a recession, and boosts US government bond yields. Given the recent events, the yield gap between 2 and 10-year government bonds amounts to almost 40 points. As a reminder, an inverted yield curve is considered by analysts as a sign of a possible recession. The US dollar immediately regained momentum amid Wall Street woes. On a Tuesday, the US dollar index rebounded sharply after several days of decline. It rose markedly versus its main rivals. So, traders no longer believe in a transitory inflation or the fact it has spurred. This is why it's hardly surprising that the greenback is growing steadily following the core CPI report. The US dollar index has already notched the biggest intraday rise since March 19, 2020. In the morning, it reached 109.55. In the Asian session, the rally of the US dollar slowed down. Now it's moving in the downward channel of 109.38 and 109.93, but not far from last week's high of 110.79. Today, the US is going to reveal the producer price index. Perhaps this is the reason for the consolidation of the greenback, yet it's sure to higher as the Fed is strongly committed to further rate hikes. While the US dollar is edging higher, the yen is trying to recoup some of yesterday's massive losses. The yen depreciated to 145 due to a downbeat inflation report and prospects of a sharper rate hikes by the Fed. Over the year, the Japanese currency has already lost 25% because of the widening key rate gap between the Fed and the Bank of Japan. Yesterday's drastic drop in its exchange rate, which looks like a vertical line on the chart, forced Bank of Japan policymakers to make verbal interventions. They again voiced concerns about the sharp moves in the exchange rate and vowed to take action if necessary. Japan's chief currency official Masato Kondo said that the government won't rule out any options for responding to foreign exchange moves. Following the verbal interventions of Japanese officials, the yen slightly recovered, hovering in the price corridor of 142.86 and 144.96. As long as the US dollar is consolidating in the narrow range, the yen could move even lower to 143.31. However, in the American session, especially after the release of the PPI index, the situation may change again drastically. The trajectory of the Aussie was quite similar to the yen. The Australian dollar is rather sensitive to changes on the Wall Street, so following a steep drop in the stocks, it lost 2% versus the US dollar. Given the weak risk appetite and the reversion of the Fed's future steps on the monetary policy, analysts expect the Aussie to return to the July low of 0.67. The Australian currency is unlikely to gain bullish momentum in the long term, even in a case of a rapid revival of China's economy. The AUD USD pair may fall considerably in the coming days. However, it managed to rise ahead of Australia's labour market report. If the figure is a positive, the Aussie could escape the bear's claws. Besides, the Reserve Bank of Australia will have room for maneuver with the key rates if there is an improvement in the labour market. The report is due on September 15. However, the Australian dollar retreated again in anticipation of this data, moving in the bearish channel of 0.6705 and 0.6749. It has already touched 0.6730. Wall Street remains rather volatile. Its sentiment may change quickly due to various factors. Today, investors are anticipating the US Producer Price Index. Tomorrow, Japan's trade surplus report and Australia's employment change data are on tap. Subscribe to our channel and keep close tabs on the market developments with us. See you soon!